Hey guys, what's up? Welcome back to the channel. I'm Miss Money. Thanks for watching, and remember to like and subscribe to the channel with push notifications turned on. Today, we're talking all about options. I'm going to explain to you how you can 10x your portfolio no matter how small using call options. I'm going to explain what call options are briefly, why they are useful for a small portfolio, and then give you some easy examples so you can go on your way and use them to make money trading. There's a popular misconception that 90% of all options expire worthless. This saying frightens investors into mistakenly believing that if they buy options, they'll lose money 90% of the time. I'll debunk that myth later in this video. When you buy a call option, you are essentially gaining control of 100 shares of stock without having to put up the money for 100 shares. So, say you are very bullish on a stock like Apple, Tesla, or whatever stock. Well, if you had to buy 100 shares of Tesla at the current price of $650, that would cost you about $65,000. Most people don't have $65,000 laying around. Well, check this image out. With $3,150, you can control the same 100 shares. Let me step back and explain to you how this all works. When you buy a call, you pay the option premium in exchange for the right to buy shares at a fixed price, the strike price, on or before a certain date, the expiration date. You can think of the strike price like the price you are betting the stock will hit. You can think of the expiration date as the amount of time you have for the bet to work out. Otherwise, the option expires. So here's a little example. Say we take that Tesla call option again. So say I pick a date like May 21st. It doesn't matter what month you are in. This works the same way regardless. So say it's April 21st. What that means is you have 30 days for the stock to reach the strike price you can see here. If the stock rises toward the strike price fast enough, you can always sell the option anytime during the market open hours for a profit. Otherwise, I usually recommend holding till at least the last week before the options start losing value quicker to see if your thesis on the stock plays out. On expiration, if the stock is above your strike, congratulations, you have made money. If it is below, the downside to buying call options is you can lose the premium you paid for the option. So looking at a chart of what your payoff would look like. So we know your strike is $750, but let's go to that image again. Notice how it says break even is $781.43. For use, it's going to be $781.50. And what I'm doing there is adding the premium that we paid for the option onto our strike. Because even when the stock hits the strike price you are betting on, you only profit after the stock has gone up enough past what your strike plus the premium you originally paid for the option. So your real goal with this example would be for Tesla to hit $781.50 per share until you start to make real profits at expiration. Of course, if the stock goes up in the meantime, you will be making profit that you can take off the table anytime. So looking at an image of our example side by side with a stock, you can see on the right-hand side, a stock makes money linearly, meaning it goes up $1, you make $1, and vice versa. It falls $1, you lose $1. Now, let's just focus on the call option for this example. This whole area below the yellow dot that says break even, that's where you are losing the amount of money you paid because the option has not touched your strike yet. Again, this is at expiration. The way the option behaves in between is a lesson of its own, and it's very math heavy. The maximum you could lose is $3,150, not a penny more. If for some crazy reason Tesla fell to zero, an investor would lose $65,000 holding Tesla stock, while you would only lose the $3,150 you paid, which also controls Tesla. I hope you are seeing where I am going with this. You can aggressively grow a small account with very little money compared to ordinary stock trading using call options. Now, very important, because I want you to be able to calculate how much money you are going to earn and at what level you can double, triple, quadruple, and 10x your initial investment. Notice how you lose money, and it's a horizontal line of the premium that you paid for the option below $750. You can see that by looking at all of these prices, $740, $730, $720, and so on, you lose the maximum $3,150. But at $750, something interesting happens. You are still down $3,150, but now we have an inflection point. The call option starts to behave similar to the stock. It moves up in price just like a stock would. So if Tesla ends at $760, well, our strike price, if you recall, was at $750. So we have made $10 on the option, or since each option represents 100 shares, a $10 gain is really a $1,000 gain. At the inflection point, we were down $3,150, but after being $10 in the money, we are actually down $2,150 at this point because we are now making some money on the option. However, it did not reach our break-even price, so we have only partially recouped our investment at $760. We hit our break-even point at $781.50 right here. This is the point where you can wipe the sweat out of your forehead and take a deep sigh of relief because it's all gravy from here. Now you continue to ride the gains, and if the stock is at $782.50, you have made $1 on the option, or again, since each option is 100 shares, you have really made $100. At $783.50, you have now made $200. And at $784.50, you have made $300. So now I'm going to ask you a powerful question and then show you the answer, which will bring you the aha moment of how call options can really make you rich if done right. The question is, at what price do you double your money? Listen carefully. All right, so we initially paid $31.50 per contract, or the $3,150. Our break even is $781.50. For us to double your money, we need to profit double what we put in. We need $6,300, which is double the original investment. All we need to do is take $6,300 or 63 and add it to our strike price of $650. So now at $713, we double our money. The stockholder needs $650 to double to $1,300 to double their money, while an option in this case doubles when it reaches $713. Now, if you want to quadruple your initial investment, all you have to do is take your premium and quadruple it, then add it to the strike price. So 4 times $31.50 would be $126. Add it to the $650 strike, and now you get $776 to quadruple your money. Notice how it grows so quickly after your break even because the amount you invested is so small. To 10x your money, you multiply $31.50 by 10 and add the answer, which is $315 to $650, and you get $965. Isn't that crazy in a good way? So investors who just buy Tesla stock at, say, the $650 mark, you would only make about 50% return if the stock went to $965. But a call option buyer would make 10x their money. So guys, if you really want to make some massive gains, you really need to dive in to call options. I'm Miss Money. Thanks for watching, and catch me next time.